Welcome back to the channel. Nick from Crozier Realty here. We service the GTA, the West End, Etobicoke, and Mississauga. We're going to switch it up today. I got a cool interview here with Nate Atkin from Hummingbird Mortgages. We're going to jump in about reverse mortgages, construction loans, how to get into the market, buying, house hacking, and just how everything works from the mortgage perspective. Nate, take us away. Introduce yourself.
Yeah,
Welcome.
man. Thanks for having me here, brother.
Yeah,
Always a pleasure.
appreciate it.
Absolutely. Nate Atkin, Hummingbird Mortgages. We essentially do mortgages all across Canada, right? Every kind of mortgage, whatever it is that anybody needs, right? We've been doing it for a couple decades. So whatever anybody needs in mortgages, refinancing, renewals, purchases, first-time buyers, whatever, we take care of it.
Amazing. Perfect. Yeah. Nate's info will be below in the caption along with mine. If you have any questions or want to reach out, the information will be right below. Let's hop in.
Let's do it.
So what we want to talk about today, we're going to cover a bunch of things that are the common questions that keep coming up that I'm seeing that are very prevalent, and also a lot of products. And there's a lot of opportunities for buyers, how to get creative in today's world, how to buy something, how to get in the market. We've all heard it's so hard, but is it really that hard? So we're going to dive deep here. We're going to jump right in here. We're going to talk about something first that I don't think a lot of people even know about or are aware about. It's called reverse mortgages. So I'm going to let Nate take it over, give us a general observation here of what exactly is a reverse mortgage, how does it work, who are the people? Give it away for us here.
Man. Appreciate that, Nick, for sure. Yeah, reverse mortgages or equity takeouts. A lot of people don't necessarily understand exactly, they think, it's only for seniors or for old folks or it can't help me, but that's not the case at all. We've seen reverse mortgages work for people to get into home ownership. We've seen reverse mortgages essentially kind of solve the problem of people and their parents sitting in a home where they have all that equity and they're sitting kind of house poor and they're not actually living their lives. So what we've done is I've actually done this for my own parents, right? So the reality is that you've got one side of things where you've got folks who sit in this home, they've paid it down for years. They've followed that mindset of sit in the house, pay it down, and then all of a sudden they're there and they're no longer working, they don't have any income, and they're sitting in a home that has no mortgage on it, but they're kind of living like month to month without any income. They have no pension or very, very little pension.
Right.
And so they're sitting there and people are looking at their parents going, man, like my folks worked their whole lives to pay off this house, but they're not really happy.
Right.
They're not old enough to go into a home. They don't want to leave yet, but they have no money. They're not really living month to month happily. So, the reverse mortgage comes into play here where it doesn't suit everybody. Like we do a very deep, detailed discovery call. It's like, listen, if you're the kind of person that's going to go out and buy a yacht with the money, then it doesn't suit you, right?
Financial responsibility. We're looking at number one.
We need to make sure that we cross all the boxes here, right? So the reality though is that, you got folks who sit there, they're like, okay, I want to be able to, help my kids pay for their wedding, or I want to be able to help my kids invest and buy their first home, first-time home buyers, or my grandkids. But I'm sitting here, I got this home, maybe I live in the GTA, I got this house worth $1 million, $800,000, 1.2, I got no mortgage. And, what do I do?
Yeah.
So we show them that you can tap into that equity by taking a reverse mortgage. So you don't have to qualify, which is different from a regular mortgage. You don't have to.
Yeah, let's dig deep on that. So you don't have to qualify.
Don't have to qualify.
Okay.
No income required. So the biggest, kind of, I would say, restriction folks have usually is like, well, if I got to get a mortgage, then I got to have income. I got to have a job. What am I going to do?
Yeah, fair. Yeah, you got to qualify.
You got to qualify, right? Reverse mortgage, no qualifying required.
Okay.
The next thing is no tax implication, and it doesn't affect pension. So for older folks who are sitting in a home, it's like, well, I'm getting this pension now. If I get this money out as a reverse mortgage, as capital, is it going to affect my pension and my income?
Okay.
Doesn't affect pension, no income, no taxes, right?
Okay.
So there we go.
Okay. So let me back it up there. So I am 45 and I paid off my house. Can I get a reverse mortgage?
Great question. No, you can't.
Okay.
You're too young.
Okay, so what would be like right now if I'm thinking, okay, Nate, tell me about this reverse mortgage. My house is paid off. Like, would you say is the perfect candidate for a reverse mortgage?
Yeah,
who does it make sense for?
Great question. So the line is 55 and older.
Okay, so there we go.
Okay, right. And the reality is that the older you are, the more suitable you are, because really we look at three different things. We look at age, we look at location, and then we look at how much equity you have in the property, so loan to value. So for example, if you have no mortgage, or you can have a little bit of a mortgage, you can own a property worth $900,000, have a $100,000 mortgage, and you could do a reverse mortgage up to usually around 50% of the equity. So let's say up to $500,000 if it's $1 million property.
Okay,
right?
fair.
And you got to be older than 55, but the older you are, the more you qualify for. Okay. So for example, there's a simple mathematical equation done on a calculator where, if you're over 60, if you're over 65, if you're over 70, the more you would qualify for.
So your loan to value, let's say, for someone who doesn't know what that means, Your house is worth $1 million.
Yep.
I'm 75, let's say. Do I fall for 50%, or they're saying I could get a little bit more?
Exactly. The older you are, you could get more loan to value.
Right. Okay.
And you qualify for more. So for example, if your parents are somebody who's, they're in their 70s,
Yep.
they've got no mortgage or small mortgage,
Yep.
and I really want them to help me with the down payment on a home, and I need like $100,000.
Okay.
No problem. That's an easy solution where it's like for sure they would qualify, no income required. They can pull out $100,000. It could be essentially taken out as a lump sum, provided to your kids.
Okay.
And the way it's structured is that there's no interest, there's no payments, you pay nothing.
Okay.
It's a reverse mortgage. So picture it being let's call it a 5-year term.
Okay.
There are different terms, but we'll say 5-year term. What happens is that at the end of the 5-year term, then the interest and the principal that you've taken, the $100,000 plus the interest, which would, let's call it, 5% interest, is then at the end of the term is then due like a regular mortgage where the parents can either, they can reverse mortgage, they can pay the capital, they can sell their home, they can do a few different things to be able to, they can collect the equity from their child that they lent it to, put it back on there. There's lots of things they can do.
Okay.
But it provides that gap and that solution for people who are like, man, I really want to help my kids get into the first home, but I don't got this money just sitting around. What can I do? Reverse mortgage is the solution.
Okay, interesting. So let's just say I want to help my kids, and I know you'd go to 50%. But I know everyone's out there saying, well, if I take out $500,000 of my $1 million home, that's a lot of money. What am I looking at after 5 years? Am I paying a certain interest rate on it? What is the interest rate if I have to, because I got to pay back the loan?
Yep.
Now let's just say, real estate, as we know, in the last 5 years went down.
Mm-hmm.
So now what happens 5 years later? Let's just say we took the $100,000 example.
Yep.
So now 5 years later, my house is worth $900,000, although that wouldn't really matter too much. So that $100,000 that my kids would have bought something with, let's just say I can't pay the $100,000 back.
Mm-hmm.
What happens?
Marvelous question. And the reality is that most people don't as well take the max, right? Like let's say, you qualify for $500,000. Well, most folks don't actually go ahead and take out that. Some do if they have plans for that capital. Some people invest it and get a higher interest return elsewhere, right?
Okay,
A lot of people do that. But to answer your question, what happens is, let's say you take $100,000 out. It's a 6% interest rate or 5%. It's a little bit more than a normal interest rate in a regular mortgage. So like right now, for example, let's say it's 5.6% interest, but it's not, you're not paying it monthly. So it's not like it's a cash flow issue.
Okay.
So it ends up being comparable at the end of the term.
Okay.
And then you get to 5 years and you say, what do I do here? I owe the $100,000 plus the interest. Well, there's lots of things you can do. Some folks decide that they want to go ahead and they want to use capital, take out another reverse mortgage. Some people say, you know what, we want to use another $100,000. Our home's worth $900,000. We want to take another $100,000 and travel, live off of it, give it to our other child, whatever the case may be.
So now they're at $300,000.
They can continue to roll with it if they like to, until they get to a point where, now they're 75, they're 80 years old. They're at a point where they're going to then sell the home and go into a retirement home.
Okay.
They just go ahead and they pay out whatever's the balance is owing.
Yep.
And they take the remaining equity, and that's their capital. So it's a way to access the money we call it sleeping money. It's sleeping in the bricks and mortar.
Yeah.
You can access it to help kids, help grandkids, invest yourself,
Yep.
live more comfortably.
Yep.
And it's a solution for some folks. Yeah.
Because I was just about to say, I think the biggest misconception I'd go out there right now is everybody thinks their personal home is a vessel, or that's an investment property. But the reality is, and I've learned this over the years, it's not necessarily an investment if it's not making you money. In theory, you're making money because got appreciation over the years and you live there. But when you look at the net score of your personal home, this is kind of the only vessel that you can actually genuinely use your home as a physical means to then purchase something else.
Yeah, great way to deliver that. The other thing is, I would say, is this is what I said to my own parents, And my parents are, like I said, they worked for many, many years, worked really hard, pay off their mortgage, got to a point where they paid off their mortgage, they retired, and they were getting very little pension, not enough really to kind of do what they wanted to do.
Yeah.
Like go to Aruba a couple times a year, do these things they wanted to do. And I said to my mom, I was like, Mom, here's the thing. Like, you're sitting here and this money in your home, in the mortgage, it's just there, it's sleeping. What's it there for?
Right.
What are you going to do with it if you get to a point where now you go to a home and you can't use it, and you eventually get to a point where you pass on?
Right.
What's the point? What was the point of spending your whole life paying your mortgage off to not actually do anything with it?
Right.
It's no different than if you rent your whole life and you put money into it, the stock market or in it, but then when you go ahead and you say, okay, now it's time for me to retire, I'm going to travel and do all these fun things. It's like, okay, now the difference is that the people with the reverse mortgage, they have this mindset like, or with the capital in their home, oh, the money just sits there forever and then you pass on.
Yeah.
Well, it's your capital. You
Yeah.
should be able to access it and use it to live the best quality life you can.
Yeah, no, and that makes sense because that kind of goes into what we're going to dive deep in here in terms of a HELOC, home equity line of credit, versus a reverse mortgage at that certain age may actually make more sense, right? And how you can generally use it. Now, who exactly, because when I'm hearing reverse mortgages, I'm thinking to myself right now, what is right now, if you were to say the number one person to use a reverse mortgage or that buyer, who would that person be in terms of if I was going to use my money other than to travel and enjoy life, because that's a whole different person. That's just using your money to use it. But let's say we want to help the kids. What would be the perfect ideal situation for that, you think?
Great question. The perfect ideal situation for that reverse mortgage candidate would be somebody who they're living in this home. They've got equity in it, a maximum amount of equity. So, over 80%. So maybe they have a small mortgage or no mortgage at all. Okay. They've got children or grandchildren who are at that age where they really want to get into the first time buy. They want to get into home ownership, or they want to get an investment property, do something to diversify their investments. That person is an ideal candidate to be able to tap into their equity and use that to give their kids or grandkids a $80,000, $100,000, $150,000 gift as from the reverse mortgage to go ahead and buy that first home and get into home ownership, especially in a market where prices have dropped 30% on average. There's a lot of great opportunities out there to get into home ownership right now at a good price compared to where it was a few years ago. That's the ideal candidate to use the reverse mortgage to help kids or grandkids get into home ownership.
Okay, because that's where I was going with it. And I crunched some numbers here, which is amazing because we're going to cover today duplex, triplex, house hacking, which is going to be a perfect segue into our next conversation here. And we're going to go over the HELOC benefits, reverse mortgage, HELOC, because again, reverse mortgage, to summarize it here, 55 plus, no payments till the end of the term, whether it be a 5-year, 10-year, 3-year. If you want to roll it over, you can. And then the ideal candidate right now, we're thinking someone that you're going to pay for your kids, reverse mortgage, give the money to the kids, they buy a property. Now, let's jump right into here because this is what I really like going hand. Something that I was big into and still going into right now because all we know in 2026 and onward here, how hard it is for people to get into the market. So why the reverse mortgage was such a really cool tool that I thought of was there's actually a way that if you were to do more of a house hack as a first-time buyer, and we're going to dive into that right now, house hacking, and what that means, what that will look like, there's actually an opportunity that if you house hacked it right and you use that reverse mortgage correctly, you actually, after that 5-year term, from tenant pay down, from a basement tenant, could actually be the vessel to pay back that reverse mortgage. So let's jump right in here because that's really interesting to me. And I think this right now, if you're thinking of purchasing or you're listening right now and you're thinking for your kids how to get them into a property, this could be a vessel to use your house, use the reverse mortgage, get your kids a property where they're able to live upstairs, rent out the basement. So that being said, what's a house hack?
Oh, I love this.
I know you love this one. I love this one personally. So let's dive in here, real basic here, break it down for me. House hacking 101. If I don't know what it is, I've never heard of it, give me a 1-minute rundown. What is it?
I will, and I'll say really quickly first what you just introed there because I'm so passionate about it. We actually have a unique program specifically we structured to reverse mortgages for a house hack with all the mortgage details in there because I believe it's the new burr. I love it.
Yeah,
we'll get into that too. So house hacking very, very quickly is this. House hacking is where you buy a property, you live in a portion of it, and you rent the other portion. So a good example of it would be, it could be a legal duplex, or it could be, let's say that you live in the main floor and you rent the basement. Simple example of it. What happens is you can appreciate is that the person who's renting the other part of the home that you're living in as well is paying rent. So let's use simple numbers. Let's say that the rent is $2,000. They're paying $2,000 to you. Well, your mortgage, let's say, is $2,000. Or $1,800 or $2,200, whatever it might be. That's your mortgage payment. So you can imagine how that income, when you live in the property, the way an investment property differs is that if you don't live in the property and it's a regular investment property, we can only use a portion of that rental income to qualify you. But when you live in it and you're house hacking, we can use 100% of the income. So that means that it's kind of like a job. So that income helps you to qualify. Even if you're working at a job that you're not making as much money, not enough to qualify for a mortgage, now you automatically qualify for the mortgage and that person's helping pay the mortgage. So essentially you're living almost free. It might cost you 100, 200 bucks depending on, you know, the numbers.
Of course.
But the reality, in my opinion, I've always believed that house hacking is the best real estate strategy forever, and it continues to be today. I love it.
Yeah, I agree. And so I crunched the numbers on it for us. So, because I jumped right in, I was like, I love this. I love the idea of it. And when I broke down the numbers, the one thing I really learned right now, and especially if you're looking to purchase right now in Mississauga, Oakville, Burlington, Milton, what we're finding is you can buy right now in the sub 1 million price point, a freehold property, no maintenance fees, semi-detached, some small detached, but they have basement apartments. So if you're looking at that, and the positive with a house hack, if we're using the reverse mortgage, they're first-time buyers. They don't need 20% down. Correct. So that is an opportunity here. And if you were to look at it on a large scale, and I'm going to make up some of these numbers, but let's just use a 5% interest rate, keep it simple, $1 million home, roughly speaking, it's going to cost you anywhere from $4,000 to $4,500 or so, give or take, probably closer to $5,000. We'll use $5,000 just because it's an easy number. So you get to live in this vessel at $1 million. Now we know these same properties were selling 3-4 years ago for 1.3. So if we use the $100,000 example, we're going to use basic numbers here because I'm roughing it all, so don't take this for certain. But $900K is your mortgage. It'll be a little bit more because of CMHC, but that's okay. We're going to use basic numbers.
Yeah, I mean, no, to jump in real quickly here, you're right. If you're putting the minimum down payment down, because you'll only need $75,000 if you're putting the minimum down payment down. You know, people like to put a little bit more.
Of course.
But if we could use that example, sure, 90, 100 grand, right?
Yeah, so we're just going to use that. And that's an opportunity now where if you're a couple, you're renting, you're thinking to yourself, like the average 2-bedroom rental right now in Mississauga is $3,100. So now you're looking at this and saying, I can live in a 3-bedroom, upstairs house, freehold with no maintenance fees, probably still going to pay 70% of utilities because the basement's going to help me out, plus $2,000 from the basement. Right there alone, you're now in this home at $3,000 a month. Now over 5 years, let's just say the market comes back 10%. Your house is worth 1.1. You're coming up for your new mortgage term because you've been in there. So what's not to say that person now can refinance their property, right? We'll use some basic numbers. Maybe you're at $850 for your mortgage, $950 we're going to because you're 1.1. You take that $100,000 back and boom, pay your parents. That is the opportunity I think right now that not enough people know about. And I think in general, if you have your down payment, forget the reverse mortgaging. Personally, I think that is the best thing you can do.
I completely agree. I love that scenario and that strategy. That's one option of a multitude of them that people can do, right? So this is one phenomenal strategy. The other is, if you picture yourself getting into that house hack, it's a catalyst for folks to build wealth for their future. So one thing that we've seen people do over the years, you know, me included and several clients that we have, hundreds of clients, is the first house hack is an opportunity to either, you know, you could stay in it if you want to for the duration, and you can use the extra equity that you have to buy another investment property. Or you can keep the property, rent both the top and the bottom, and then go ahead and buy a second property that you go ahead and house hack again. You could do it over and over again if you'd like to, and accumulate a portfolio of investment properties and build your wealth.
And that was the big one too, because, you know, in the US, it's a little different because we do have Canada listening in and whatnot. But the US, there's a little bit there's more advantages when you sell an investment property. We won't get into it, but tax implications, right? Canada, we know we get taxed a lot. This is the vessel to avoid that situation.
Hang on
to
it.
Exactly. And that's where I think your biggest opportunity is, because I think what some people don't realize too is when they do their pre-approval, let's just say, you know, and I'm going to see where on average we would land, but if someone has about $2,000 income coming from a basement and say I'm pre-approved for $900 today, on average, roughly, what would that do to help me get a better pre-approval?
Substantial. I mean, that we use 100% of that income. So if you picture that extra $2,000 a month, about $24,000 a year, that really jumps you up substantially, a couple $100,000 of qualifying.
So there you go. So just use it. And that's something I don't think people realize right now, because, you know, where we're seeing the markets right now, there's opportunity. There's lots of opportunity in terms of the freehold market. We haven't seen come down to say the low 900s, high 800s for semi-detached properties with basement apartments. Right? And that's kind of an opportunity where you're saying, hey, if I'm pre-approved for 900 and I'm looking at towns and maybe some semi-small, that 2,000 can bring you to a 1.1. That actually could even get you into a detached property today.
It could get into that home that you thought you wouldn't be able to get into for another 5, 6, 7 years or even a decade down the road. People in their mind think, this is my first home, my intro home, then maybe that's my next home. Well, a lot of people now we're having qualified getting into that home they've always wanted right away. They don't realize that right now they can get into that home.
And I think that's the biggest opportunity with house hacking in general. If you really want to be a savvy house hacker, this is kind of your second option for it too. Because house hacking doesn't actually just have to mean that I'm going to have an upstairs, rent a basement, right? I could be a young guy, young girl, 25, 26, just finished university. Well, what do we normally do? We go rent a condo. We go rent with a friend. Well, now with the rules and how things are changing, that same $1 million home, if the $75,000 is the least I need, that doesn't say, well, wait a minute. If I'm going to go rent a condo at 800 square feet right now and live with somebody, what if I did the exact same scenario and two of us bought the house, we live upstairs and rent the basement? Now that $3,000 a month went to $1,500, and now we just walked into an opportunity where we're paying $1,500 each, someone's paying $2,000 in the basement, and we're living in a freehold home that 5 years later, we get to sit there and say to ourselves, and what I always recommend for this when you go with a friend, a partner, brother, sister, family member, you always have up a nice agreement. Set yourselves up with a 5-year plan. Don't do 2, don't do 3, decide 5. Because on average, we talked about this a little bit here with real estate, and this is something to note if you're looking to get into the market. Don't be an emotional buyer. You're gonna be there for 5 years. Plan if I'm purchasing a real estate home, whether it's for myself or an investment property, 5 years minimum before I say if this was good or bad.
Yep.
My rule of thumb personally,
I agree.
I don't believe a real estate purchase can really be determined good or bad for a minimum of 5 years.
Yeah, and we got to let the market do its thing. It takes time. It usually takes at least 5 years for the market to shift in either direction. But again, to further your point there, in terms of what it does as well, if you jump in with a friend or what have you, the house hacking, not only does it help you with the qualifying and the income portion, but as we talked about, you could use if you have parents that are able to reverse mortgage that equity, or even if they're not 55 and older, there's also the ability for parents to maybe refinance to get a little bit of capital to help you with that initial down payment. So there's lots of solutions.
Yeah, and the big thing I liked with that is it just gives you options. If I'm only paying there and I want to enjoy my life, I want to have the nice house and I want to be this and that. When I started real estate, the vessel was kind of more of where the prices were. You can kind of get into freehold. Condos were kind of in that spot where pre-construction was the big win because you're buying them at almost market value. It made sense 10 years ago. Right. It doesn't make sense anymore. And personally, I've never been a pre-con guy. Luckily, we've got away with it.
We have to pivot with the market.
We got to adapt and change. And I think, again, it goes back to house hacking, find the friend. And again, when you find the friend, even if you have 3 friends that do it with 3 bedrooms, right? You can go into a bigger home, a 2-story. If you really think about it, guys, that's $30,000 each. Literally, that's $90K, 3 people, right? Maybe you have a good close friends, that's a couple. The couple wants to live downstairs. The other 2 are upstairs. That's 4 people. Now we're just really running the numbers here. 20K. There's so much opportunity, guys. I think the really big takeaway, what I'm pulling from this is, if you want to become a homeowner and you're serious about home ownership, there's ways to do it. And I think in today's world, it's about being creative, understanding financing options, and then realizing we need a plan, working with your agent to come up with that plan and stick to the 5-year plan. And I think that's kind of your vessel to really set yourself up for the future.
And to wrap that up, that portion right there, it's the truth. You said it very well. We're seeing so many folks who they come to us either from realtor partners or as clients that they don't think that they can qualify. They're like, I don't think, I'm not quite there. But when we bring them in, we onboard them and we go ahead and get them, do a pre-approval, do all the details. They find out very quickly that, wow, I actually do qualify, and for more than I thought I would. And that's the big thing.
That's awesome. Well said. So we're going to pivot a little bit here. So we want reverse mortgages, house hacking, finding that money. I'd call it from a tax-free standpoint, running it that way, the benefits of it all. But now let's just say I'm not 55, right? I got my house, maybe I house hacked it out. I'm on my forever home. I got kids. They got to afford a house in school. I got, maybe 40%, 50% equity built up in my home. They just turned 2 years old and I'm sitting there saying, this education fund isn't going to do it right now. How am I going to get them into the property? Can I use my property now? And how do I actually use this? Because some people are, 45, 50, and they're sitting there like, man, my house is almost paid off. But like we talked about earlier, it's not really a vessel of an investment because I'm not using it for anything. So what would a HELOC, home equity line of credit, what does it mean? How does this work? Who's it good for? When do I do it?
Great question. So when it comes to a home equity line of credit, equity in general, refinancing, all this kind of stuff, we always we take a step back and say, let's look at the entire picture here for these folks, right? Let's understand what the goals are, where they want to go with this, how much capital they're looking for, how much cash flow they have from their regular jobs and income, and we look at the whole picture and we say, okay, listen, here's a solution for you here. You've got this home, you bought it 8, 9 years ago, 11 years ago, whatever it might be, and now it's worth $1.2 million. Your mortgage is $600,000. So you've got this gap there in equity, and you've got needs with life, right? Yep. So once we do an analysis and look at it, we say, yes, indeed, you can do what we call a home equity line of credit. It's essentially, it's using that equity that's there, that gap, that spread. Your property is the leverage for it. It's saying my home is worth $1,200,000. My mortgage is $600,000. I could really use $100,000 here to do whatever it might be, whether it be help my kids, help my grandkids, or there's other needs when you're a young couple and you're growing, that sort of stuff. You can access that equity through the home equity line of credit, and you're able to do that up to a percentage of 65% of your home's value. Right? So there's quite a bit of a gap there, but there's that space because of your own protection as a homeowner, and then the lender, the bank's protection. We want to say, listen, we don't want to leverage you too high. We would never want to put you into a position where you're taking too much equity out, and then if the market shifts, you're in a little bit of a troubled situation. So you can leverage it up to about 65%, take that capital out and use it for investing, use it for gifting, use it for whatever you need it for.
Okay, interesting. Okay. And now from that standpoint, what am I looking at rate-wise, cost-wise? Is it like a reverse mortgage? Do I pay right away? What am I looking at with a HELOC?
Great question. So a HELOC is just like a normal mortgage in the sense that you have payments, but you can pay. Picture it like, it's open, we call it. So let's say, for example, let's use round numbers. $100,000, take $100,000. Well, what happens is if you draw all of it, you've got that space. So the bank will say, okay, you're approved for $100,000 line of credit. Let's say you only want to use 50,000 of it. So you pay interest only per month on the amount that you use, like a credit card, right? But interest is far lower. So the interest rate is going to be closer to your mortgage interest rate. So it's usually like, we call it prime plus something. So it might be, if your interest rate for your mortgage is 4%, maybe your HELOC is 5%.
Okay, so you prime, and prime being, what's prime? What does prime mean?
Prime is the interest rate that the overnight lending rate that the banks have. So without getting too technical, basically prime is like a rate. We'll call it right now, let's say it's 4.45, right? And then they'll say, okay, so your mortgage variable rate might be prime minus a percentage. Okay. Your home equity line is going to be prime plus a percentage. So to use simple math, let's say it's 5%.
Yeah.
So if you're going to use $30,000 of your HELOC to do whatever you're going to use it for, you only pay interest only on that particular draw that you've taken out. And you can pay it. The difference is that you can pay it back down anytime. So if you know what, I'm going to use $20,000 to lend it to my brother for something, he's going to pay me back. Or people use their HELOC to invest. I've used my own personal HELOC before to go ahead and buy an investment property. I've used it for the down payment, knowing that when I refinance that property, I'm going to pay the HELOC right back.
Right.
It's open-ended, so you don't pay a penalty like your regular mortgage to dump a chunk of money on it. You can just pay it right down.
Fair flat. Okay, cool. So I'm not using my HELOC to go on a nice vacation. I'm not buying
Hopefully you're not buying a yacht like the other ones, right?
Okay. So similar in a sense, I think the number one thing to take away from all of these options is it's almost as if you're using your money. It's cash you get access to, but you have to look at it from a standpoint of, if I'm being charged 6%, we'll say, whatever I'm moving this money to has to make sense, and it's going to return me more than 6%. I think that's the caveat a lot of people miss with home equity line of credit. It's free money I get to pull from and use, but the reality is you should only really be using this, for emergencies. Things happen, we get it, life happens. But if you are planning on using the HELOC or your home vessel, I think the number one thing, or the number two, correct me if I'm wrong, let's go off this one here. I'm going to say the 3 things I think you should use it for. You tell me if it's yes or no. Number 1, of course, is going to be buying an investment property. Things make sense. I'm going to take $100K, put my 20% down. Hopefully the rent, the cash flow and everything else are going to cover each other. I pay it back.
Okay.
Number 2, emergencies. I got to pull the cash, something happens, I got to use it. And my third one here, and this is kind of my interesting one here, because this is always the one that's up for discussion, is do I lend the money, invest it in the stock market? Maybe I do some private lending with it. What would you say that third alternative usage for a HELOC could be? Or is there something that would be, this is what you should be doing right now?
Great questions. I'd say there's 4 uses.
Okay,
And let's go back to it. So number 1, 2, correct, for sure, emergencies. investment property, if it makes sense, we, meet with a real estate professional, run the numbers, make sure that you have a strategy and an exit strategy. Yes. Number 3, I have a lot of content on this on my page, in fact, about this. Whether or not you should use debt to invest in things like Bitcoin.
Is your YouTube page or Instagram?
Yeah, both. Yeah.
So right down here, hit the link right there.
You'll find it. You'll find it. So should you use debt to invest, right? Like some folks take it, they buy crypto, right?
Okay.
They'll buy stocks, NASDAQ, whatever it might be, or other forms of investment. I caution against doing that unless you really, really, really know what you're doing. You have a good financial advisor. It's because you're using debt in investments that could collapse.
Go up and down. Exactly.
And that money comes due no matter what. That interest is due for that HELOC no matter what.
Exactly.
Right.
And that's why you kind of want to offset.
For sure.
Or have an income coming at least.
I most definitely caution on that one. The fourth thing that we didn't really talk about. So you've got if you're going to buy an investment property, emergency funds.
Yep.
If you're going to go ahead and you're going to potentially use it to invest, debt investing.
Okay.
And then the fourth one is going to be if you want to go ahead and access your HELOC to help out family, right? Like we get a situation where a lot of folks have they're helping family with their particular debts, and so we've done a lot of debt consolidation because people have helped kids. They've helped kids. They may have a daughter who's going to be, or a son who's going to be having a wedding, and they want to use, they're like, I need to help my daughter in their way. We don't have all this money sitting here, or we don't want to redeem our investments.
Right.
So we set up a HELOC and we help our kids with their wedding or with their, their first time buy, right?
Okay.
So helping kids, helping grandkids, helping somebody else, that's another reason to use the home equity line. But yes, it's always very important that when you're tapping into that home equity line, that you know the numbers. Yep. It does make sense to use I completely agree, to use a 5% HELOC if you can achieve and yield 10% over here with another investment or more. Makes complete sense.
Okay, interesting. And then honestly, to actually piggyback, which I kind of have gone over with some clients sometimes too, is especially if you've been in your house for 20 years, 30 years, I guess this is the 5th vessel, is using your HELOC and having it on your home for the sake of having it. Are there costs to have a HELOC? And then my 2-part question to that is where I think the biggest opportunity for someone on a HELOC is someone who's thinking of selling. Because there's always that little bit of stuff you need to do on your home. Whether that be, and again, this is going to be repainting it, ripping out that carpet that's been there for 30 years. And I'm not saying go and do a whole overhaul, because don't do that. Talk to your agent first, please, on a side note, because we're seeing some bad things out there where people are doing renovations that don't make sense. You're renovating things that aren't going to return you value. But another option is through that, you can use your HELOC to renovate, construction, whether that be upkeep, and just getting that property ready. Because again, you can take a HELOC for 3 to 6 months because you're going to sell your home.
Fantastic advice. In fact, what we do for folks, we almost always recommend when we're doing a renewal or refinance, if there's an opportunity to attach a HELOC onto the mortgage or structure the mortgage style so that there's a HELOC there, we often encourage folks to do that, because that then provides you don't pay a dime, to answer your question, on the HELOC unless you're using it. You pay nothing.
So it just sits there, you're good, no big deal.
Sits there. It's like if you have a credit card, you don't use it, you don't pay for it.
Okay.
It's just there. But it's always good to have that capital and equity there in the event that you do need it down the road, because if you go to get it later, you may not qualify, you may get turned down, you may have to pay fees for it.
Right.
So when there's an opportunity, when you're refinancing or renewing, we like to structure it there. And the second part of your question is, yes, indeed. It's great to have there for those little things. You never want to over renovate, which we see a lot of people do. But yes, if you don't want to tap into other capital or investments or backup funds, have that HELOC there. It might be $10,000, it might be $5,000, it might be
20, 30 max.
Yeah, anything, nothing crazy. Right? But it's there, and that way you don't have to worry about that.
Okay, interesting. Okay, well, that's great, because I wanted to sum that one up there, because that's going to bring us into our next point here, what we're going to go over, because that's actually going to fall right into construction, loans, back into the buying. Right now where I'm seeing it from the real estate side and the agent side is there's so much opportunity in homes that need work. And I don't mean a full gut job overhaul. What you're seeing today is the turnkey properties for what they're selling at versus a home that's, let's say, not turnkey, may need a kitchen, some flooring, some paint. The gap from what you're buying it at and what the other ones are selling at, they actually don't make sense when you work out what it would cost to make the house look that way. For one of the first times, I'm really seeing the gap being very, very big. Like you're talking, and we kind of talked about it earlier, but I'm just going to use semis in Mississauga because we're going to touch for our house hackers and everyone listening. But you're finding the semis that need work that you're probably talking like 80 to 100K of a reno are in like the 8s to 875 range, but the exact same renovated ones are 1.1 to 1.15.
Sure.
And you're like, I buy this at 850, put 100K, I'm at 950. I have a lower mortgage, so my monthly costs are lower. If I add that basement apartment, now that's going to even help me with my costs. So
it's your taste because you renovated it the way you want it to.
Exactly, but I don't have a HELOC or a home. So maybe I have a lot of cash, or my parents are going to give me that extra cash, whether it be a HELOC or there's this construction loans that we keep hearing about. So give me a little breakdown. We're going to jump in here about construction loans. Who can it help? What is it? How do they work? How do I qualify? Because this is really another vessel of you could purchase the property, do the rental you want, and then still get your money back. Take it away. What exactly are we talking construction loan? Because this is a great option for people. I've had clients do it.
Phenomenal option. And what we call this in financing is purchase plus improvements is what it really is, right?
Okay.
So construction loan. So people think about that. They think construction, they think big, huge, massive. No, not necessarily. A purchase plus improvements is going to be a mortgage that includes a budget to do a renovation.
Okay.
So purchase plus, right? So in that case, there's certain things that are required there. So for example, let's say you're going to come into this home. You're like, hey, Nick, we're looking at this property together. I'm your client. I love it, but we need like $100,000 worth of work. We got to redo the kitchen, the bathrooms, the floors. Okay, well, let's talk to our mortgage professional and find out what that looks like. Okay, super. We can qualify you for the mortgage plus the $100,000 for the improvements. The way it works, it really is simple. Like you can get approved up to a certain percentage of the purchase price.
Okay.
That'll differ, but in reality, it's cosmetic stuff. So it's not going to be structural things.
No,
right? We can't be doing beams and taking out and doing additions and things like that, right? It's mostly aesthetic. And you can go ahead and get qualified for that. So what happens is, it's typical stuff. You'll need contractor quotes and these sorts of things to provide the lender with. They'll say, okay, great. Look, this looks like it's verified. Sounds good. No problem. Super easy to qualify for it. The lender will then go ahead and approve you for your mortgage and that purchase plus improvement budget. So you have that capital to move in, do the renovations, have everything the way you want it to be, and it's all gone ahead and built into that mortgage for you.
And then how does this work? So I want to buy $1 million. Let's say the $1 million property I want to buy.
Yeah.
I got 75 down, but I want to do a new kitchen upstairs, put the flooring in. It's going to cost me $50,000. How do I qualify for the construction loan?
It's quite simple, really. The reality is that you're qualifying like you normally would for the mortgage. Okay. And there's the portion of the budget that we do for the purchase plus improvements, the renovation portion.
Okay.
We go ahead, we put that in on with the application. Okay. The lender looks at it, says they'll approve you up to 95% loan to value with the purchase plus improvements. So you can go ahead, if it's an insured mortgage. Okay. So you can go ahead and you can get your regular mortgage portion plus the renovation portion approved. What happens?
Okay, so with this example, let's say, $1 million purchase price. I got 75 down, and I need 50.
Oh yeah.
So I'm going to be basically looking for 125 from the mortgage. And so what would be my mortgage was going to look like then? It's going to look like, what would that be?
So let me understand what you mean exactly. So I'm buying the property, and you're talking down payment wise.
My down payment is $75,000. I'm buying $1 million property, and I need $50K as a construction loan.
Okay, absolutely. So what's going to happen then is that the down payment is on its own portion. You have to provide that anyways, no matter what.
Yeah, that's it.
So you come in, you buy the property. Your mortgage was going to be $925,000 anyways, right? So then your mortgage is going to be the $925 plus the $50,000 for the reno. Okay, that's your mortgage amount. But it gets amortized over the full life of the mortgage, whether it's 30 years or 25 years. So your payments are, quite small.
Yeah, it goes up. Yeah,
it adds into that for you. So your $50,000's in there, built into that amortized mortgage. So it doesn't come out of your pocket. The bank's giving it to you.
Okay, so your loan per se will be $975. Yep. But because you did $50,000 into it, reno's done. The property's worth $1,050,000 to $1,001,000.
And what'll happen is that the bank will actually we'll go ahead and give you a mortgage for the after repair value. So if you wanted a larger mortgage, so for example, you want to qualify for that larger insured mortgage, they'll give you the money for the after repair value. So when you're done the reno, let's say it's appraised at now 1.1. Yeah. Oh wow, well you can actually get a mortgage for the loan to value up to the 1.1 million instead of the 900,000 that you bought it for.
Oh, interesting. Okay. Yeah. So do I need the $50K cash myself, or like what does that look like? So I close on my property, I get a mortgage of $975, or am I getting a mortgage of $925 and I get $50K?
Yeah, great question. So what happens is the bank, the lender, will go ahead and forward the full $950,000 to the lawyer in trust, right? Okay. When you close, they'll go ahead and they'll pay out the mortgage, so they buy the home for you. Yep. That capital sits there in trust. So what happens usually is that, in most circumstances, is that you pay the contractor, and as soon as you pay the contractor and show the invoice that's there and paid, the lawyer releases that capital to you.
Okay,
Yep.
okay. So that's how it's. So that 50K stays in like a
Trust.
trust that's a slow release vessel as I spend.
Yeah.
So I kind of need the 50K on my. So theoretically, then, if I'm buying this $1 million property, I need $125,000. Just that 50K I'm going to get back.
You get it back. Yeah.
Okay, so that could be a great option for the reverse mortgage, the HELOC.
Yep. The refinance.
That's
yep.
where the parents and the grandparents can use that vessel. If now we're going back to our equity, your kids have the 75, 80K down. This is an opportunity for them because we do know right now the renovated homes are selling much higher price, but it also allows them to keep their monthly payments lower and get into that property.
Yeah, and drive the value up. That's the
Yeah,
thing too. We
that's
always
the
say
key
in
part.
real estate,
Force
we
the
say
appreciation.
absolutely make money on the buy. So
Yeah.
you go ahead and you buy it for a lower purchase price, and when you're done, it's worth as much as that other one that you were going to buy, and you've customized it to your renovation needs, right?
Interesting.
Yeah.
Okay. I like that. Are you seeing a lot of people using this program right now?
You know what? I don't think it's used to the capacity that it's there for. I think a lot of people just don't know enough about it. They don't know that it actually exists. So when they do
Right.
find that out, oh wow, like we do talks all the time, and I'll speak to real estate teams all the time, and again, remind them to remind their clients that this is an option that you have. So once folks hear about it, like the reverse,
Yep.
they think, oh wow, I didn't know that that existed. That's really cool to know. So
Yeah.
when they find out about it, of course they'll use it, but I think that there's so many folks that just don't know.
Because what I was thinking here, my mind's just going here because this is something that this is almost perfect for your person who wants to upsize, right? And in today's market, you're looking at it that 2,500 square foot plus home right now, completely turnkey renovated. I'm just going to keep using Mississauga as the example, but you know, you're looking anywhere from renovated 2,500 plus, 4-bed, 4-bath, anywhere from call it 1.4 depending your area plus.
Yep.
Really renovated, really nice. You're probably 1.6, 1.7 plus. But that house not renovated, I'm seeing them go for the 1.25, 1.3. So now I own my home today. I want to get that extra closing going on, and we're not going to get too crazy with bridge mortgaging and whatnot. But maybe I got 500K of equity I want to bring over to the home.
Yep.
Would that be something where you would say, you know what, guys? Why don't we say, hey, let's get you into that 1.3 house, put 200 of that 500 down payment you would have done as a construction loan. So we put 300 down at first. We get our 200 construction loan. We do our whole renovation. Now our 1.3 turns into 1.5 because we spent it, but it's really worth 1.7.
That's right.
Or 1.6. We're not
right.
going to go crazy with the numbers.
That's real estate 101, right? That's how you build wealth and make money in real estate. You buy, you make money on the buy, you buy it as low as you possibly can, you drive value by renovating it, you force the appreciation, and all of a sudden now that home that you bought is now worth $300,000-$400,000 more than it would have been otherwise.
That's exactly where I was going. And to note on that too, like part of what our team does is we do have a construction avenue of our team. So if that's something that sounds like you'd be interested in, please reach out because that's been what we've been helping a lot of clients do. And depending on the appetite for construction, renovations, it can work for some, it cannot for others. It depends on your situation and family situation because again, it's not easy going through renovations. Caveat is it sounds all great and easy. It does take some time. There's some ups and downs to do. But again, if you want to make that money, you got to put some effort in. I think that's the key part.
And if you want to customize the home into what you want it to be and not by somebody else's finished product, right?
And I agree, especially as someone who wants to upsize, I think that's what you're looking at, that forever home, right? You jump into that forever home and you sit there and say to yourself, well, you know what? In 10 years, it'll be great. We'll renovate. Well, why wait 10 years?
In 20
Start
plus
to enjoy
years,
it today.
In 20 plus years of doing this, I've never seen a time that makes more sense for people to upsize if they wanted to already, just because of the price. Right now we're in a unique situation where you got the price of homes is down and the interest rates are down.
Yeah.
Like historically low.
Yeah.
So you've got the combination of prices down and interest rates down. So for people who want to get into that forever home, we've never seen a better time for upsizers to actually do it than now. And we've helped hundreds of people do that. Yeah.
Well, and that's what I was just going to say, because, to piggyback on that as well, you have exactly what you're talking about when you're talking, okay, we have our low interest rates, low prices. And then what else do we have? Lots of sellers want to sell. Normally when you run into a low interest rate and the price is low, the market starts to really take off. But we're actually seeing the opposite happen right now.
There's a gap right now, and for sure, there's a gap right now to take advantage of that.
And that's kind of who we've been really working on, right? Because, in every market, I'm not going to sit here and say, hey, it's always a great time to buy. It's got to make sense. And I think right now, the downsizer who says, I want to sell my big home, but it's not worth what it was. It's paid off. I have no need for a reverse mortgage, no need for HELOC. If you're asking me personally, it may not be your time yet, unless you're going to a condo, unless you're moving out of the country, out of the city. It can make sense. But I think right now, the opportunity is in the upsizer, right? And that brings me to my next point we want to jump into here is, and this is what I've been really working with my clients on a lot lately is how do we get ourselves into the upsize? Whether that's a simple upsize from my first condo, maybe it's the upsize from my first detached property into that next home. I think the transitionary period right now of where real estate has changed from when our parents bought homes, right? My dad's still in the first home he bought in 1988, right? Which nowadays, you're not buying a detached home for the price he paid and having it paid off in 5 years. So I think the opportunity right now is understanding that first condo, whether it's a 1+10, a 2-bedroom, is going to be a next vessel in 3 to 5 years. Or that first townhouse is going to get you into your next freehold. That freehold, semi-town, or small detached is going to be that next jump. And then there's a third level of jump that I don't think a lot of people, and I call this the comfort jump. Because you're comfortable right now. The 3 bedrooms are great. Do you need the 4th? You're probably not having another kid. But what I've noticed right now and what no one thought about and our parents thought about is that inflationary factor. Yes, that house that's paid off right now, or I have a great thing, I could upsize, but I don't need it because I'm comfortable. But that upsize, if you're sitting in your early 40s, 45, well, if you upsize today, when you're 65, 70, that I think is the one part that we're not thinking about. That property that could be worth $1 million today, maybe $1.5 million then. Every 10 years in real estate in Ontario, the market's doubled. So if you're in that $1 million house today and you don't upsize, 10, 15 later, maybe it's 2. I'm just making up the numbers here, but let's just say 2. But let's say you upsize into that house, that's going to be a 1.5. Right? That difference of $500,000 can be huge.
Well, $1 million, yeah, like you said, in your example, in 10 years, yep.
Right? So I think that's kind of what we'll kind of jump in here. And like, what are you seeing right now? When would be the right time to make the upsize? How do I know? Like, I'm sure there's a lot of people out there where that's, they're feeling a little pressure. They've been in the home for 8, 10 years, 12 years. Like I said, that comfort level is there. But when do I know, okay, I got to make that jump?
Yeah, of course. You lay that out well. It's very personal, and of course, only the family could know for sure. But from our side of things, we're data and numbers kind of guys, where we run all the numbers and make sure all the data and numbers make sense. So for folks who are like in that position where they're thinking, at that stage of life where income is solidified, they're doing well, they're in that position where they're comfortable. The home may be feeling as though they're growing out of it slowly. They kind of felt like maybe it's been like that even for a few years. And they think or thought that dream home is beyond reach.
Yeah.
Right now, we're seeing that it's actually not for a lot of folks. They thought it was beyond reach, but when we go ahead and we look at their equity, we assess the equity they have in that home they're in now, that they've been for a while. And then we look at, the income they're making, their net worth that they have with their investments, things like that. We realize, hey, you know what? You are actually right on the doorstep to that upsize of that dream home that you thought was out of reach because of the market we talked about. It's dropped. It's down 30% on average most places.
Yep.
Rates are down. For you to be able to qualify and get into that dream home, you can do so. It's actually much more of an affordable jump than you thought it would be.
Right.
So it's very case specific. We let the data and numbers draw that, but yes, right now more so than ever, we're seeing people get into the home they didn't think they would either ever get into, or maybe it's going to take me 15 more years. They're getting into that home now.
And that's kind of where I'm kind of sitting here saying, like, if you're in a situation where maybe you just had the second kid, still the wife's on maternity leave, maybe that's not the time yet. And I think that's kind of understanding where you are and what's going on. Because also, if you don't have an investment property, maybe the kids are 5, 10 years old. Well, university's 10 years away, right? That home now, that's going to be that jump today in 10 years, right? That could be the vessel, whether that be that HELOC, pay for the kids' education, that investment property. I think there's an opportunity there where there's 2 options you go with. And I think if you're sitting there at your 10 years in your home, I think that's kind of the sweet spot, I'd say.
Yeah, the equity's built up, you're there.
That's what I mean. I mean, we're talking anyone who bought a house really, I'd say pre-2017, 16, you're still in there, things are good. And I would encourage you, if you're in a condo, 2-bedroom, condo, townhouse, anything with maintenance fees right now, I think that right now is your biggest opportunity. Get out the maintenance fee. Because at the end of the year, start thinking to yourself, if that maintenance fee is $500 today, $600 today, what's it going to be in 20 years? You can it's very easy. You just talk to your real estate agent, find me a complex that's 20 years older than mine. Where are the maintenance fees? It's going to be pretty similar, but you got to remember to yourself, why do you want to still pay maintenance fees when you're retired? The house is paid off, right? That's your opportunity. Get out of that maintenance fee house.
Good advice.
Because you don't need to really even jump into some massive home. you can get right now a semi-detached or a townhouse, and we're going to stay with Mississauga, but 750, 800.
Yeah,
We just sold a
freeholds.
semi for 780.
Yeah.
So like, and your condo townhouse for 650, that jump isn't that big of a gap.
Yeah, right now we're in that position where it's really shrunk. That gap is tiny.
That's what
now.
and I mean, you think of it in perspective. Oh, but I don't want to take an extra $100,000 on my mortgage.
If I could also add to that as well, from a qualifying mortgage perspective, people don't necessarily realize this, but when we're running your numbers and doing your ratios and your pre-approval, if you have condo maintenance fees as a line item versus someone who doesn't, that substantially hampers your approval. If you're paying $400, $500, $600, sometimes $900 if they're older condos.
I've seen it.
When you're paying that much on your condo fee, it's like a mortgage. It's another debt. It's like a credit card debt or a mortgage debt that's on there. So you're substantially hampered by a condo fee in terms of your approval. If you could remove that off, but upgrade to that freehold or that detached or semi-detached home, you can qualify all day long.
Because that's what I was kind of, you took the words out of my mouth. Because what I was thinking was, if I'm paying, my condo townhouse is worth $650. That freehold is $800, but I'm paying $600 maintenance fees. That $150, $200 gap that I might have to go up in mortgage is literally my condo fee.
That's the qualifying wise, it's essentially right there. Yeah.
Right? And I mean, I think that's where you got to look at your situation now, and we understand, we finally saw, I don't want to, call the condo market what it was, but we actually saw what happened in the condo market. A 1+ den and a 1-bedroom from $650 to $450.
We did.
Right? And I think that's going to take a long time to recover. But even if you looked at your investment as a long term, because the condo people that are suffering right now are really most people who bought as an investment property to rent it out because the rental rates dropped 30%, your price dropped 30%.
For sure.
It is what it is. And I think that's the level you got to think about it. If I do have 3-4 condos that are investment properties right now, maybe they're breaking even, I'm a little bit negative cash flow somewhere, this is your opportunity. Consolidate it, sell them all, and get that detached, that freehold, that duplex, triplex, that multifamily. This is your opportunity in your market to kind of consolidate it out and start looking at your cash flow, because I think the big thing that I look at when I think of upsize, and I'm not thinking personal home upsize here, this is investment upsize. I got a couple condos I want to get into, duplex, triplex. What I try to tailor it to my clients is I always say to yourselves, what do you want your gross income to be when you're 65? If I'm going to say I want to sell 2 condos right now because the maintenance fees are $5, I'm paying $1,000 between the two, and I sell these 2 condos that are getting me $2,200 each in rent. So I'm at $4,400 between the two. If I consolidate the 2 of them and buy a duplex that brings me $55,000, $6,000 in rent, long term.
I think being a long-term real estate investor myself, I think that's great advice. I think people get roped into the dialogue of either like number of properties, number of doors, how many properties do you have, how many do I have, as opposed to just the money at the end of the day. Because really, what's the goal of real estate as an investor at the end of the day? It's really, either cash flow or net worth or whatever that is. It doesn't matter the number of properties, but like you said, if you can go ahead and take a volatile condo portfolio of multiple properties, 3-4 properties that are having condo fees that are very erratic. We don't know where they're going, and you've got tenancies that are erratic, difficult and unpredictable, and you could wrap that up into one property that is a freehold that you can control. I think that's a phenomenal decision.
Because that's where I think right now, and I'm just getting away from just your personal consumer who wants to upsize, there's also the opportunity for and that could be something where you have 2 duplexes and you want to jump into your multifamily, right? We didn't really touch about multifamily here, but kind of a side bonus part here is the multifamily, because you're hearing more and more about it today. And, me personally too, being in real estate the last 10 years, I actually didn't start learning about it the last 5 years or so. So I think this is an avenue where I don't want you to think that just because you have condos to upsize, there is an upsize in your investments too. Because like you said, I think the one misconception, if you're a new investor, you're thinking that don't get caught up with, I need 50 doors, 100 doors, 80 doors, because, you can go out to North Bay somewhere in Sudbury and buy 10, 11 doors, but now you got 11, 10 headaches that are all over the place. So when we're looking at an upsize for an investor standpoint here to touch on, if I got 3 duplexes right now, what would you say my next step, my jump is? What's my risk factor? Or for that investor who's really looking to scale and get into that property, what would you say I'm looking for, or what should I be thinking about?
Yeah, excellent question. When it comes to multi-family, we're talking about 5 doors or more.
5 doors or more, exactly.
And then we're talking, so everyone's aware of what we're
Commercial
talking.
financing.
Commercial, residential commercial we call it, right? So 5 doors or more. where things change from the financing side is that now we're qualifying the property, the income of the property.
Okay.
And as an investor, to answer your question, when should I start to think about maybe going into that space? Well, first off, if you're super comfortable and you love the smaller stuff, then don't think about it. Stay there.
Okay.
If you're somebody who thinks, you've been listening a little bit, consuming content, you got friends that might own small apartment buildings or purpose-built 8-unit properties, whatever the case may be, then you want to make sure that you are coupling up with other people who have done it, because the reality is that from the financing side, when we're qualifying somebody in multifamily space, it has to be somebody that they've either done it before, they have experience, they've got people on their team or in their group that are familiar with multifamily, because it is different. There's a lot more involved there. So you want to start to have conversations with people that are in that space, that either own property in that space, are financing professionals or real estate professionals in that space, so that you can learn a little bit more about it and decide, is that for me? Because it's a great jump to make if you're ready for it.
Yeah, fair. Okay. No, I just want to touch on that one there, because I know there is that savvy investor listening who, it's about consolidating. There's opportunity everywhere, right? That could be your opportunity. That asset you've had that just keeps breaking even because that one lemon of a house, which we've all had from an investor standpoint. We chatted about it today. There's always one. There's always one.
And it's true. It's true. The game of Monopoly is true. The reality is that you stack the houses and eventually you go to the apartments. And it is true that you do eventually make that jump. So, to have that discussion with someone like you or someone like me is the best starting point to see, am I there yet? Or what do I need to do to prepare to get there?
Yeah. And to jump off that topic, but to wrap that topic up, please, all I ask, if you're not using us, use a professional who actually owns multifamily.
Yeah, yes.
The one common mistake when we're analyzing people's properties or portfolios is you always ask them, well, why did you choose this property? What made you buy this? I don't know. So-and-so told me, or the realtor said it was a great idea. Does the realtor own properties? Do they own investments? Have they dealt with the landlord board, the tenant board? Some questions that I would recommend asking your advisor is, when did you go to the landlord board? What happened? Was it for non-payment? Was it for eviction? Was it for, anything can happen nowadays with landlord. Was it a complaint? Do they have experience with it, and are they able to manage and handle it? Because investing is not for everyone. I think the big thing that was missed in the last 5 years, I want to touch on a little bit, because this is going to piggyback into our last segment here, which is going to be about just mortgages, rates, mortgage agents, real estate agents. Why do you pick them? How do you pick them? And we'd love for you guys to use us, but what we're saying is, if not, have these questions and conversations with your realtors and your mortgage agents so that you understand and they know what you're looking for. Because I can tell you right now, an appraisal on your house that you bought on your duplex for $1,000 is not going to cost the same on a 10-unit building. The lawyer is not going to cost the same on the duplex as you would on the multifamily. I tell conditions, everything.
I tell people all the time. It's like simple. Break it down to this: your whole life. Okay, like are you taking your what does your personal trainer look like? Okay, like, is your personal trainer fat and out of shape? Don't hire them as a personal trainer. Is your financial advisor your broke uncle who's driving up in a beat up car? Right? Don't take financial advice from that guy. If you want real estate investing advice, take it from somebody who's done it before. It's that simple, right?
I can't say it more and more. And ask the questions. Just ask the real questions. Sometimes you don't want to ask the questions because you're afraid of the answer. A lot of time we know the answer, right? And we're not saying that the person is not good or bad, but if you're going to be making these financial plans and these big decisions, especially when you get into commercial and 5+ units, you're talking $2 million, $3 million plus assets. These are not small spending. You're putting $600,000, $800,000, $500,000 down. A roof on a 10-unit apartment is roughly going to cost you
a couple $100,000.
Yeah. You don't have that in the bank. You don't have that. You could be in some big trouble. Well, thanks so much for coming in, Nate. We really appreciate all the information. There's been some great information here from home equity line, house hacking, reverse mortgages. Again, the bottom is going to have our information there if you want to reach out, set up a phone call to actually deep dive into your situation. Thanks for subscribing. If you like this, hit the subscribe button, and we will be doing this. We're going to try to check in with different professionals amongst the industry. Leave some comments if there's any people you want to see, you want to hear from, or any topics you want to know. We'll be jumping on there to discuss it all.